Which one's better? Oh,
Okay, admitting everybody here. 1, 2, 3.
welcome. I believe we've started right now. First of all, I want to thank you all for attending today's very, very important session. My name is John Pacheco, and I'm the president of the Latino Chamber of Commerce of Minnesota. And it's our mission to help young Latino businesses grow and prosper in Minnesota here. And more importantly, help the state of Minnesota prosper as well as we all grow together. Today, we have a very important webinar together, and it really came out of a need that's been described by some of the businesses we serve, particularly the business along Lake Street who were so damaged during the George Floyd riots on Lake Street there. A lot of the business didn't own their own building. And if you didn't own your own building, you didn't receive the money to replace your inventory or the building itself. And so we had more people calling us wanting to learn more about how they could prepare going forward and whether renting, leasing, or buying is an option that they should consider. So what we have today is we have a great person who's dealt with this for years and has a really significant resume in commercial real estate. And his name is Luis Olvera. And let me tell you a little bit about him. I have to read it because he has such a long one. He has over 18 years experience in international business, contract negotiations, development of subsidiaries, exports, imports. Some of the past credentials are presented courses in importing into the United States to the University of Minnesota, 3 years professor at Anahuac University of Mexico, teaching international trade and commerce, as well as corporate development and promotion in the last 2 semesters of a bachelor's degree, translated a world opportunity to the Minnesota Trade Office from English to Spanish, and our past treasurer of the National Association of Hispanic Real Estate Professionals, a Twin Cities chapter, professor of Latin Economic Development Center at LEDC in commercial real estate, and currently director of membership. So I'm pleased to introduce Luis Olvera for the presentation today. And I would let you know that this is all being recorded as well. So if we miss some things, don't have to worry about taking too many notes. If you miss some things, we'll be able to again for you. We also have this session coming out in Spanish in another week. So again, to help some of the business owners that would prefer that, have it in Spanish. So again, I'm very pleased to introduce Luis Olvera. With that, Luis.
Thank you very much, John. It's an honor and a privilege for me to be able to be present in this conversation. And of course, the universe of commercial real estate is so vast that we will need virtually weeks to really go in depth of these topics that we are going to just scratch the surface today. So without further ado, please do not have your cellulars on, pay attention, relax, watch and learn. So here we go. Fasten your seat belts. This is going to be fast. So obviously my computer doesn't want to go to the next slides. Okay, let's see. Okay, oops. Okay. We are going to start, first of all, with a recap of the first installment that we had. I was about a couple of months ago, and we visited what was the definition of real estate, which is basically all real property that is above the ground, the crops, and everything that is from the parcel to the center of the earth. So if you happen to find gold or black gold, it's all yours to keep. So when you go back home, please start digging. You might be lucky today and find some gold. Then we studied the different kinds of real estate, which basically, of course, are residential and commercial. In the residential, we have up to 4 units. If you start with 5 units, then it's commercial. And from there, everything else. Cemeteries, churches, gyms, movies, restaurants, office buildings, warehouses, name it. All of that is commercial. And then in the last installment, we saw the Lucky 13, which was the principal difference between residential and commercial. If you would like to have a copy of those, I would be more than happy to send them to your email. So you have at least 13. We can talk about 20, 30, or if you want to go furthermore, we can discover more differences. We would like to say at this point that take away everything that you have learned as far as residential real estate is concerned, open your mind and receive a little more. And that is the universe of commercial, okay? So here we go. What is the process to purchase real estate commercial or commercial real estate? The first thing that you have to do is to have a very clear definition and decision of what are you going to have. You are going to have multifamily, 7-unit, a warehouse of 13,000 square feet, or a movie theater of 500 seats, or a restaurant of 100 seats. You have to define exactly what is it that you want. Once that you decide, you go running to a commercial real estate agent. Do not go to your compadre that sells tamales in the corner, please. A commercial real estate agent has, by definition, an army of allies that are going to help you in the course of the transaction. Let me give you some very few examples. We have structural engineers. I have used 2 of them already. We have people specialized in industrial roofing. We have people specialized as locators. You know what is a locator? It's when you are going to start construction or modification of a building in place. Excel and Centerpoint is going to be very angry if you poke the lines, believe me. So you have to hire, contract a locator. You have to contract a commercial general contractor. You have to hire a real estate lawyer. You have to have a commercial title company, and you have to have, of course, guess what? A commercial loan officer. If you don't want to write, it's okay. We're going to send you this presentation via email, so you have it for your records or for your later view. Okay, so just pay attention, watch, listen, and learn. Okay, so here starts the fun part. You went to the commercial real estate agent, you talk to him or her, I'm not jealous, and you define the firm objectives that you are going to pursue. Immediately you go and sit down with a commercial loan officer to become pre-approved, okay? And here is where the fun part starts. Contrary to residential, remember, we are not going to be even close to residential. These are the main programs of commercial. There are more than 500, but I think that these are the 6 most important. And I divided them whether you are going to apply with a Social Security or if you have an IT number, which is a person that does not have a Social Security number. So the first one, which I believe is very important, is the 10% down Small Business Administration. Careful, the Small Business Administration does not loan or does not give the money. Small Business Administration guarantees the payment of the loan. Basically, there are 2 loans. There are 7A and 504, and the difference is between the requirements. Careful here, because the 1st of October, they are going to change the rules, and every 1st of October they do. Nobody knows what are going to be the new regulations. So if you are going to go through SBA, try to have it at least presented before the 30th of September, obviously this year. This is available to social, but is not available to IT. What kind of loans I can get with this SBA? Well, unfortunately, not for multifamily. You can get for a warehouse, you can get for a movie, you can get for a restaurant with the real estate. Very important, we're talking real estate here. We're not talking business. We're not going to acquire a business right now. We're going to talk later about how to acquire, how to evaluate a business. Right now, we're talking the real estate, a building with people inside, a restaurant with the structure, everything together. That's what we're talking right now, okay? Another
Hi,
very
Luis.
important program is the 15% down. This is applicable when you have that is owner occupied or owner operator. For instance, a gas station. There's a classical example that the owner is going to be operating, not necessarily filling up the tanks of the cars, but is going to be as administrator or directly involved in the business. Again, available for social, not available for IT number. Business loans. Business loans are available with social and not available with IT because of the risk that the bank is going to incur if the person is with IT. The business is negotiable. The terms and the time is very, very negotiable with the bank. Another way to purchase real estate, commercial real estate, is through a line of credit for business. Some institutions can borrow you up to 100,000 just with the signature, depending upon your credit. This is available for social, not available for IT. Now here comes the fun part. 20, 25, 30 down, 5, 10, 15, and 20 years. Be careful of what I'm going to say. 5 year. 5 year can have different assumptions or modalities. It can be entirely amortized in 5 years. I borrow you 100 and the 100 is going to be paid in 5 years. Done deal. Another one is 5 years, but you are going to pay me only interest. That starts to get interesting. Another modality is you pay me some principal and full interest and a balloon payment after the 5 years or maturity. You can do the same with the 5-10, the same maturity 10, everything is amortized, you pay me in 10, or only interest or balloon. 5, 10, 15, or 5, 10, 15, 20. Okay, so you start imagining how many things we can do in commercial. So it's up to the imagination to get the deal done. And then, of course, you know, the real estate per se, which is the purchasing cash, etc. Now, we are going to complicate this chart a little bit more. And we're going to say that if the purchase price is more than $1.25 million, okay, then the loan comes non-recourse. What does that mean? That means that the banker is going to apply his formulas to determine that the property itself is going to be able to pay the loan. So you as a person or as an LLC company are going to be kind of in the sideline. What is the property that is going to respond first for the loan? That is recourse, non-recourse. Recourse is 1.25 less. The non-recourse is 1.25 more. Okay. Let's get deeper into the black hole. How about?
Hi, Luis. Sorry to interrupt.
Hey.
This is Anita. I just wanted to check. We've got a question from the audience. I didn't know if you wanted to address
Can
those
we,
right away. Or
can we respond to questions at the end?
at the end. Got it. Sure.
Please,
Thank you.
please. I would appreciate very much.
All right.
Thank you very much.
Thank
Okay,
you.
so then go deeper into the black hole. There is Peter that wants to buy a restaurant with the real estate and it costs 100, well, let's talk big, 2 million, okay? The restaurant with the equipment, the business, the real estate is $2 million. For starters, is non-recourse. Then the banker is going to request 3-year financial statements of the present restaurant. And here comes a very interesting tricks or series of tricks. Watch out. Number one, if the restaurant sells tacos and the new owner is going to sell tacos, then you do not need to make a business plan. If the restaurant sells tacos and you are going to sell, what do you want, paella and Spanish food, then even though it's a restaurant, the banker is going to request a business plan. Okay, now more tricks to the cat. Peter is going to buy the restaurant, $2 million, but guess what? He's going to have to make repairs, upgrades, additions, etc., new hood, and so on. And that is $200,000 more. Guess what? You can start stacking into the same loan these kind of items. And also, because the banker is a very good friend of this guy, he's going to say, you know what, Peter, you will need $150,000 working capital, which I'm going to include in the loan. So at closing, I'm going to give you the working capital. You're going to pay me in 5 years or 10 or 15 or 20. I'm going to give you the 200,000 for your upgrades and to the 2 million. What you have to bring to the table, because it's a restaurant, we're going to go SBA. You give me 200,000 plus about, let's say, 50, 60,000 closing cost. And we have a deal, Johnny. Let's do it. So again, as you can see, imagination is the limit. Many things can happen. And I'm just talking about the loan, okay? And there are 500 more programs to choose from. So the universe is interesting. So coming back to center, we went to the loan officer, we went pre-approved, then we go and tour. We don't show, we tour the targeted properties. We are looking for a restaurant, 100 chairs in Uptown. We're not going to go to Farmington to 500 chairs. Okay, so it's very, very targeted what we're going to tour. Then we like one restaurant, one multifamily of 27 units, and we write a letter of intent to the listing agent. The letter of intent is a non-binding document. You can put the date, let's say August 8 to September 8 is good. Please start to negotiate. In this letter of intent, where, as its name says, we're going to show the listing agent and owner what are our intentions. Our intentions is that we're going to shave 10% of the price. We want concessions. What is a concession? Like, for instance, 2 months rent for free. We want the owner to change the boiler. We want the owner to change all the doors of the 3rd floor. Those are the concessions that the owner is going to put for free. We write that in the letter of intent and we start to negotiate. That negotiation, in my experience, I have had cases have lasted 2-3 months. Just this kind of negotiation, okay? Once that both parties are in agreement and we can proceed, go back to the loan officer. We said, okay, Mr. Loan Officer, this is the final terms that we agreed. Now let's polish the pencil, see what are the real final numbers, and let's develop the loan package. Then from there, guess what? We're going to write the purchase agreement, which basically is going to be approved because we already have negotiated the terms. So it's a no-brainer, you know? And from there, we start again, more fun part. We start all the inspections. Number one, careful, the banker is going to ask likely environmental inspection. What is that? Well, remember that I told you about the commercial realtor? We have geologists and we have environmental companies that do these kind of inspections. And the environmental inspections basically are 2. The names are phase 1 and phase 2. Phase one, the environmental inspector comes, makes 5, 6 holes in the ground. That is why we need a locator. We don't want to get offset Excel or center point. And the guy makes the holes, goes to the laboratory and tests for gases. I have had a situation that the gases came bad. So for that is what? The banker demands to go to phase two. Phase two, the case that I have, obviously I'm not going to say the name, but it was about 5,000 square feet of a property. The phase two was going to be $16,000 to $18,000. And then we have a problem, Houston, because who is going to pay for that inspection? The seller doesn't want to pay because he's leaving. And the owner or the new buyer or the soon to come new owner doesn't want to pay because, hey, you're selling me a property that is contaminated. So what the heck, no? So it's a very, very tough, very fine line in negotiation. In my case, we negotiated phase one, pays the buyer. If needed, phase two, half and half. We agreed. And in that particular case, the phase two was going to be in the neighborhood of $18,000. We went to phase two. We pray that the ground was not contaminated according to the rules and regulation of every city, etc. And as an example, the maximum was 8 and the result was 7. So we relaxed, everything was happy, everybody was happy. We paid half and half of the phase two. And just as a parenthesis, if it was contaminated, the mitigation system, remember, 4,000 square feet was going to be $95,000. And nobody's going to allow the business to get open, and there is not going to be commerce or trade or anything in that property. It's going to be condemned. So be very careful with phase one, phase two, especially if you are going to buy gas stations. Or another thing that nobody kind of pays attention is if the property is close to a dry cleaner or a tanner, you know, a leather cleaner, because all of those chemicals are most likely contaminating the ground for years and years. So when you go and buy the next block, your beautiful building of 21 units, guess what? The mitigation system is going to be $150,000. And people have to go out, have to vacate. So you're going to have a problem. So you have to be very careful with this kind of inspections. And you have to have geologists and a lot of very in-depth professionals here, okay? Okay, then here's when we get our money, guys. And this is called the due diligence. The due diligence in Spanish is fiscal, fiscal, financiera, the 3 Fs. In English, I divided by the physical, the fiscal, and the financial. Let's dive into the physical. We are going to be the director of the orchestra doing all of these inspections and all of these due diligence items. We are not going to make holes in the ground because we are not architects or engineers, but we are going to call a structural engineer to make the examination and inspection, and we're going to get the report. We're going to coordinate those kind of activities, okay? So very quickly, we're going to have all the revision of the physical assets and equipment. If it's a multifamily, we want to go to the laundry room and see how are the washer and dryer, if he has a contract with them, if it is owned, what is the state of each machine, if he has any other contract, how is the boiler, how is the conditioner, and we're going to see each and all of the units in a multifamily. 37, we're going to go to the 37 units with our cheat sheet, and we're going to start checking every aspect of each unit. That is why we write in the purchase agreement contingencies. and owner has to pay $25. Okay, so be careful how you structure your transaction. Environmental issues, I think we talked. Coverage of insurance, very important. If I fall down in a building and sue the owner has to have the correct insurance to pay the $500,000. We are going to check the foundation. We talk about that. The roof, we talk about that. Mechanical, we talk about that. We are going to perform the unit inspections, utility bills that they do not know. 6 months of center point. And as I commented already in depth, the environmental assessment. Very, very important, the environmental assessment. Careful, careful, careful. The next part of the due diligence is how we get our money, how we make our money, is the fiscal. The fiscal, his name is there. We're going to review at least 3 years of income tax declarations. Very careful because 90% of the businesses, oh, but I do 20% cash and it's not declared. And I mix this with my other business and I deduct my daughter's school in Harvard. So be very careful when you make this kind of analysis. I recommend you to go to a CPA, pay $1,000 and ask him to review these income tax declarations of the business, because we are not lawyers and we are not CPAs. So don't trust me that I will be able to see all the codes of the deductions, etc., because I am not capable and I will not do it because it's my skin that is going to go in the game, okay? But you have to do it. And that goes for state, federal, local, and municipal. Especially if you are you want to buy a business, say a restaurant with the state, the real estate, all the permits and licenses. There is everything to code. It happened to me already that the guy bought the business and he opened the business, the new owner. The inspector comes and says, you know what? That reparation over there was not with a permit. So you are going to tear it apart, we get a permit and put it again, the way it should be. And that was $12,000 that obviously my buyer was not contemplating or budgeting. So he very, very careful that everything is to code with permits and everything's above the law. Okay, guys and girls. Next, this is a very, very interesting. We can spend here 3-5 days just in this chapter. And this is called the finance. You have to dig into the books. As I say, we're not accountants, but at least we have to have certain knowledge of how the books are. It has to be up to date. We're going to ask for financial statements for the past 3 years. The report, you have to ask for the credit report. You have the business credit report as well as the owner credit report. You have to have a summary of inventory. You have to make a physical inventory if it's a restaurant, how many tomatoes and how many onions. I am selling a liquor store as we speak. It was fun to go to make the inventory for about 10 hours and count how many bottles of tequila were there. So you have to do that to make sure that what you are selling is there. And make pictures, please, take pictures. Because in the night, the tequila bottles are going to disappear. So be careful with the physical inventory. Accounts receivable, accounts payable is a no-brainer. And then depreciation and amortization, you have to go to the invoices of the assets that they have. If it's an industrial purchase, you have to see when they bought it and what is the depreciation, what is the maintenance log, all of those things. The realtor has to do that. That's our homework. That's how we make the big checks, guys. We have to do that. We have to do the material contracts and agreements, all the agreements that the company has with whatever, international, national, or local. We have to go and, we have to go to the customers and ask them, hey, how this company is treating you? make a survey of the customers. What kind of customers they have? If it's a gas station, if it's a restaurant, if it's their tenants. No, hi, my name is Luis and I am the real estate agent for the buyer. I would like to see how you have been treated in the last, according to your lease, is 3 years. How it's been doing? And make a report of the 37 units. That's how we make our money, guys. And it's a hard work, but somebody has to do it. And then the last for the list and the more fun, analysis and interpretation of the financial statements. Again, we're not accountants, but we have to have some kind of knowledge to be able to analyze and interpret the financial statements. We have to go and make the financial ratios, which is the liquidity, leverage, and profitability. Liquidity is what money do you have in order to survive. The leverage is how much money you owe, and the profitability, as its name denotes, how much profit the company is making. And of course, again, you can talk, we can talk 3-4 hours in this topic, and you have to make that kind of analysis. Furthermore, if you want to complicate your life, you can make some ratios. And then if you really want to impress your buyer, you can do what is called the DuPont analysis, which is a combination of ratios. And also, if you really want to impress, you do a sensitivity analysis. Sensitivity analysis is for now that we have inflation or inflationary pressures, you tell your buyer, okay, for every $100 that the tomatoes are going to increase in price, how much sensitive your business is for making profits. And you have to make a very interesting mix because the tomatoes go in salsas, the tomatoes go in the spaghetti, and the tomatoes go in the rice. So then you start complicating your life about, you know what, Johnny? Don't make salsas with tomatoes anymore, because this is going to hit hard in your profit line. That is the result of your sensitivity analysis. And you have to go until that kind of analysis. Okay, guys and girls? Okay, so let's go back to center. And we make our due diligence. A very interesting thing in the due diligence when we talk about physical is that, and it happened to me, so I will tell you my experience, you have to go to the police department. Why? Because you are going to ask, hi, my name is Luis, and I am buying 123 Main, and I would like to know if they have had any domestic violence, any shooting, or any situation that has involved you. And guess what was the response of the policeman that interviewed me? Oh yeah, they're very good friends. We go there every Sunday, or Saturday and Sunday. They call us every weekend. Do you think we bought? I don't think so. So you have to go there. You have to talk to the police. Another experience that I have, I already told you, with the fire marshal, you have to go and say, hey, this property has had any fire. In my case, yeah, it had a fire 7 years ago. And the guy, of course, cut corners, called Juanito to patch the roof. And guess what? $12,000 after the fact. So you have to do all these things. It's very, very interesting to do them. And for me, it's exciting. I don't know for you, but it's challenging and exciting, not to go to the police and to go to these guys and girls and get to know them. And then, of course, you have to have a commercial title company, which basically is the same job as residential, but with the name of commercial. Sometimes it's necessary to hire or to contract a commercial lawyer to make some more writings. And finally, if everything goes according to plan, after 9 months, the baby is born. You go to closing, and that's what happened to me twice. The transaction took 9 months, and we were laughing at the closing table because a baby has been born after 9 months of this adventure. So yeah, commercial is very slow. We have had one deal with senior housing. After 13 months of doing all of these things that I told you guys, guess what happened? The surveyor came 4 weeks before closing, and the surveyor determined that we were encroaching the adjacent land. And the other guy, guess what? Didn't want to sell. And we wanted to give you all the money in the world. No, because this land was from my grandfather. I'm not going to sell it. So we couldn't make the deal. So the deal is done when you have your check in the bank, guys and girls. Next, we're going to talk, let's make a parenthesis and let's talk about businesses. I think that I express a little bit myself in terms of how to evaluate a business. You have to ask, obviously, the financial statements. You have to make the due diligence, physical, fiscal, and the other one, you know, and that is for a business, okay? In comparison to real estate, that the real estate is going to have the structure. A business doesn't have the structure, but basically the path is the same. You have to analyze the contract, you have to analyze financial statements, you have to talk to the customers, et cetera, and then you evaluate the business. And how you evaluate the business? Very different than how you evaluate real estate. In real estate, you have the cap rate, which is a capitalization rate, which is the ratio between net operating income and price. And then you deduct mortgage, and what is left is cash on cash, because that you will compare with the cash that you put in, with the cash that you are taking out, yeah, bottom line, and that is cash on cash. That is basically the 1, 2, 3 for real estate. For business, it is another approach to evaluate a business. The first and foremost thing to have into consideration is if the business is owner-operator and is required to be owner-operator or not. Because as an investor, if you are going to buy a business, you want to go fishing. You don't want to open at 4 o'clock in the morning to cut tomatoes. I'm sorry, unless you want to knock yourself out and you want to close at 10 o'clock in the night and sweep the floors and go to bed at 12 midnight. I applaud you, man. Good for you. You're going to make a lot of money. But that is an owner operator. And therefore, the value of the business demerits because you have to be there 24/7. In comparison to a multifamily, it's a business, but guess what? You have a property manager and you go fishing, okay? So the way to evaluate a business is more with ratios. You remember the liquidity, the profitability, and the leverage. You do the sensitivity analysis, and this is really kind of what you have to do. And then there is another approach which is called the multiplier approach. The multiplier approach is based upon the FTDA, earnings before taxes, depreciation, and amortization. That amount, whatever it's the result, you have, Google it, you have your multipliers. And depending upon the kind of industry, and depending upon the size of each of the industries, you apply a multiplier or multiple of. The smaller is the business, the less amount of multiplier it is. The bigger the company, the bigger the business, the bigger the multiplier is. That makes sense, no? So for instance, manufacturing, you have a multiplier of 4. So whatever you have of earnings before taxes, depreciation, and amortization, that amount, you multiply times 4, and that is the price of the business that you are willing to pay. And that you compare in the market. You make a comparative market analysis of the same industries around the 5 miles in circumference, okay? Construction, multiplier of 3.5. Wholesales and distribution, multiplier of 5 or 6. Information services, all that is technology, etc. You can have a multiplier of 10. Why? Because information systems is something that is evolving every day, guys and girls. So if the company is for sale and it's information systems, man, go for it. Because this is going to change very, very often. Financial services, multiplier of 7. And of course, you have to see the company itself, if the structure is falling apart, if the business has been 10 years or 1 year, how many employees, all of those ratios are taken into consideration to evaluate the business. It's not a one-shot deal, a straightforward situation. It's a lot of numbers. You crunch numbers and you keep on crunching more numbers to evaluate a business. Okay, so we have 16 minutes. Man, I am impressed myself because I am up to the calendar here. Let's talk a little bit about rents. And this is commercial renting. And I have here 3 models of rents. The first model of rent is what is called the triple net or NNN, which embodies the 3 nets in the lease, which are the property taxes, the building insurance, and the CAM. What is the CAM? Common area maintenance, which means, for instance, in this building, beautiful building that we are, is the maintenance of the elevator, the maintenance of the wonderful stairs, the doors, the guy that tells you where you're going. That is CAM, okay? That can be involved in the lease, and that is the language or the lingo that is going to be used in the lease is like, for instance, this is just an example, $30 a square foot, triple net with $5 for CAM. Okay, just as a side note, we realtors will collect our commission on the $30 because that is the base rent, and the CAM we do not. But here comes the kicker. If the lease is for 5 years, and this is going to be a very simple example, $30 a square foot, 1,000 foot, 5 years. What is going to be your commission? Let's do it mentally. 30,000 times 1,000, excuse me, $30 times 1,000 is 30,000. 30,000 divided by 12 is roughly 2.5. Okay, 2,500. $2,500 is going to be the monthly rent based in addition of the 5. Okay, now 2,500 times 60, because it's 60 months now, 5 years, is 120,000. 120,000, your commission is going to be 7%, 5%. You negotiate your commission, and that is going to be your commission. Here comes the kicker, realtors. You write in the letter of intent and in the lease agreement that after the 5th year, that is going to be renewal. Guess what? You collect 2% commission on perpetuity. So, hey, baby, let's rent some properties forever. That's how we collect our money. Another way to do the office building, for instance, is $1 per square foot. And that applies when the property is very small. Okay, times say 7 years, etc., the same process. And in the renewal, 2%. So that's a kind of a candy every 5 years that you will receive. Okay, so this is the CAM. Basically, this is retail. Standalone properties is very, very common to use this kind of lease agreements. By the way, I have had 50 to 55 pages lease agreement. And of course, we have to read it all. And if we do not understand, we go to real estate lawyer. Okay. Another kind of lease is called full service gross. This guy is when you put, of course, your CAM, your base rent, but the tenant pays to the landlord for the expenses like utilities, the taxes, insurances, 3 CAMs, the janitorial, the guys and girls that come at 6 o'clock in the afternoon to clean the garbage cans, etc. of the building, that is going to be involved in the lease agreement. And it can be per square foot or an annual rate or a negotiation between the parties. These are very commonly found in office buildings, as I commented, for a reason, and obviously lower quality retail and industrial centers. That's basically where it is used, these kind of leases, okay? And the third one is a combination thereof. It is when everything is negotiable. You can have your triple M plus modified gross, but I don't want to pay the water, and the insurance is going to be paid half and half because I pay the inside insurance and you pay the outside insurance. And the janitorial, well, you know what? Maria, which is my sister, is going to come and clean the office. I don't need that. And you can negotiate everything that you want to negotiate, my friends. And this is the wild, wild west of the commercial real estate. Welcome. I appreciate very much your time, your attention. And I am not Google, but I will try to answer your questions. Thank you very much for your presence. It was awesome.
Thank you, Luis. Thank you, Luis. Great presentation. I just have a couple of questions here from mostly from Felipa, actually all of them. Felipa, you want to just jump on and ask your questions?
Sure, I can do that.
Yeah.
Go slow so I can repeat the question, okay? Please.
I'm sorry, what did he say?
If you please go slow so I can repeat the question, so everybody understands. And because I have guys here in front of me in person.
No, that's fine. Yeah, I don't mind.
Thank you.
Well, thank you for the presentation. My first question goes back to the beginning when you had the chart that said Social Security or ITIN. When you apply, number 4. You said, can we apply with the EIN, a business EIN?
Absolutely, yes. That is how actually the bankers like, you know. Let's say you, Felipa, is going to apply for a loan because you want to buy a multifamily, 7 units. What the banker would like you to do is to form an LLC, or even you can form a C corporation, and the C corporation is going to be the entity that is going to have the loan, comma, Felipe, or whomever it is, John, Peter, whatever. So yes, please do.
So the
it's
EIN,
very important that you have another moral entity or legal entity.
So when you put it on the chart, EIN is equivalent to the Social Security chart.
Correct.
Column? Okay.
Correct.
Okay, thank you. Okay, so then my second question, or did you want to repeat the question to the others there?
Oh, yeah. The question was if it is okay to have a employer identification number. And my answer was yes, absolutely positive. Actually, the bankers love that you come with the company instead of Peter Sanchez, you know, with social or without social. And a very interesting point here, there are banks that because of compliance, they don't even touch with a 10-foot pole IT number. There are banks that do IT loans, but careful, not business, just real estate. And the interest rate is the same for all the children of God. So it's not an overcharge of interest or anything like that. And the terms are the same, 5, 10, 15. The exception, remember, no SBA.
So EIN is not SBA approved?
EIS, yeah,
Oh,
because
okay,
you are a
okay.
legal
You're
entity.
talking about ITIN.
And,
You're
and
talking
you know
about
what?
ITIN.
Yeah, I know
Okay.
where you are going. It's a very fine line because imagine that you and I form an LLC. You have a social and I do not.
Mhm.
But then we go to the banker and the LLC is the one that is going to ask for the loan. And
Mhm.
guess what? I will never see the banker and you might get the loan.
Okay.
So that's tricky.
Okay, my second question is, you explained very well the process. If you go to slide 5,
The next one.
yeah. No, I'm sorry, slides, what is that, 6? Yes, the due diligence.
Okay, here. Oops.
You can go to 5.
5?
Yeah.
Okay.
Okay, so you've mentioned the due diligence. So we would, I guess, why would I not want to do the due diligence or right after I get the purchase agreement sent? Or, like, wouldn't I want to do the due diligence before I submit a purchase agreement?
Because sometimes you are negotiating the okay. Why couldn't I do the due diligence before the purchase agreement? That's the question. And my personal answer would be that is because you are still negotiating the letter of intent. Because remember, when you finish and agreeing the letter of intent, immediately you go to the PA. So it is after the PA that you start the due diligence. Yes, you can start with due diligence. For instance, in my personal case, right now I am helping a buyer to buy a restaurant with real estate. We have been negotiating the letter of intent for 3 months. We don't have the purchase agreement, but guess what? We already went to the city to see if everything is up to par. I visited the police to see if there was any violence in the restaurant in the past. And I have already lined up my roof inspector, my structural inspector, and I have talked to the banker if he's going to require an environmental inspection. So yes, you can start being proactive if you will,
Mhm.
but not necessarily spending money. Because what about if in the last moment that happens, that everything is fine and dandy, but in the last moment, the owner dies, the owner says, no, you know what, 10,000 more because of inflation. Or I don't agree with the phase 2 that you didn't tell me. Or the structural engineer comes with a situation and the owner says, nope, I'm not going to change the structure. And you already pay all these items without the PA. So then, it is a catch-22 kind of
Okay, I get
situation,
it.
no? So you have to be very careful. What is first, the chicken or the egg? You can start building the nest for the egg, but don't buy the chicken.
Right,
you
okay,
know?
okay. And then I had another question.
Please.
You mentioned that you made a joke about it. You said, oh, let's get to rent more commercial real estate. But which party pays the contract renewal?
What party pays for the what, excuse me?
So you said, let's say I wanted to lease some retail, right? And then
Okay.
I do it for 60 months. You
Okay.
said in the contract, the agent would, if they renew, they get another 2% payback.
That is negotiable, yes.
Okay, but who pays that to the
The
agent?
landlords.
The landlord.
Mhm.
Okay, okay, good to know.
Mhm.
And then I don't know if
And of
anyone else
course,
has more
because
questions.
the landlord in 5 years is your client today, he is going to be the one that is going to pay you in 5 years.
Okay,
So
okay.
the roles reverse.
Okay, got it. I don't know if anybody else has more questions because I have more.
Let me tell you a little bit about the commission thing too. I have had one instance in which it was not even 5 minutes that we met with the landlord, and he immediately looked at my eyes and with fury says, "And don't even think that I'm going to pay you commission, mister. Talk to your buyer, he's going to pay you. Take it or leave it." So then guess what? So, Johnny, I have to talk to you. This is my commission rate. Let's make some business here, no negotiation, because this guy is not going to pay me anything. And I don't work for free, Johnny, I'm sorry.
Okay, thank you for answering that. You mentioned something about hazardous or like if
Environmental?
well, along the lines, I'm trying to remember back because I had to write down my questions. Okay, so you said if you buy a property, but you don't want it to be near a dry cleaner. Is it
Yes.
a dry cleaner or a laundromat? Are they different or the same?
Okay, very good question. Actually, I'm selling a laundromat in St. Cloud. And it is the same, it is an animal, but it's not the same animal.
Okay.
And let me tell you why. The dry cleaner to wash the clothes uses chemicals, big time chemicals, and they go to the ground and they contaminate the ground. That is the dry cleaner. The laundromat uses detergent, and nowadays it's even kind of a little regulated, and it's not, goes to the drain, and it's not really that harmful. So the short of your answer is no. If it is a laundromat, you will not have that kind of situation.
Okay.
But there is always a but. How about if there is a gas station in front? Then the banker is going to require phase 1 and phase 2. Phase 1 for sure, and depending upon the results, phase 2. So you have to be careful with the surrounding areas. And when you do that, your due diligence, I will tell you a secret. You go to the city and you get all the prints and drawings since 1900 to today. And in that search, then you will discover who was where near the property in question. Okay.
What if
I
the
think
city?
we have a time for one more question. If it's okay, it's 3:01.
Okay, yeah, if anybody else has more questions. Because I have another one.
Okay. I'm losing 10 pounds here. Go for it.
Oh, okay, okay. Okay, so basically, I already own rental property, but I want it, but it's under my personal name. How can I convert it to the business? Because I already have an LLC for property.
Okay, my best advice, go to an accountant
Okay.
and you can transfer or transform or change. Very, very, very simple, easy. Because it's going to be you to you. It's going to be a no-brainer, easy peasy, and it can be done in a week or less.
Perfect. Well, thank you, and you're welcome for helping you lose weight.
Absolutely, no, my pleasure. It was fun. I hope everybody liked it, and let's do it again. If you need a copy of the presentation, let me know. This is my information. And if you have any further questions, etc., I'm also green designation. You know, a little bit about renewables, etc., recyclables, that we didn't touch that topic. And I am here to help you answering any question. So feel free to contact me, and I will be very happy to send you the presentation and the first installment that we had a few months ago. And we're going to have another one in November.
So thank you. I'm not sure where All right. I'm just going to repeat this here, but thank you very much. I really, actually, I've learned quite a bit on this workshop, and I know it will be helpful to a number of our members. We are repeating this workshop in Spanish. I'm not sure the date yet, we've set it up. So if you have somebody who would also benefit by this, or if you'd like a refresher in a different language, we'll have that available as well. This has been a really important subject to our members, and so I really appreciate the time that Luis has provided us to do this workshop. We've had more calls. We've had more people sign up for this workshop. We had over 30 people sign up this workshop than any other workshop. I think most of ours combined. In the day of the pandemic and everyone doing these webinars, it's very impressive that we've had this kind of turnout as well. So I want to thank you all. I hope we didn't take too much more of your time. We just got barely over time here. And if you have any questions, again, call us over at the Latino Chamber of Commerce or reach out to Luis yourself. His information is there as well. So with that, I'd like to close the program and thank you all very much for attending.
Thank you very much to all.